When can you retire? Most people try and answer that question by running a retirement projection or a Monte Carlo simulation. Those tools are useful, but I believe that there's a better question to answer first. What return does your retirement actually require? I call that your retirement hurdle rate. It's the minimum annual return that your investments need to earn from retirement to the end of your plan for your money to last. And once you know that number, you can compare it with what today's investment markets are capable of delivering. That tells you whether your retirement can largely be purchased, or whether it requires a reasonable amount of market risk, or if your plan is asking for more than the market currently appears to be offering. I'm Michael Carbone. I'm a CFA charter holder, a certified financial planner, and a partner of a financial planning practice in Greater Boston. This channel is about helping you make better retirement decisions, period. So how does the retirement hurdle rate work? Most retirement projections begin by assuming an investment return. Maybe you or a financial planner assumes that your portfolio earns 6% or 7% throughout retirement. Then the software projects your spending and calculates whether your plan succeeds. The hurdle rate approach works backwards. So you start with the parts of your retirement that you can actually see and influence. How much you have saved, how much you spend, when Social Security begins, how long the plan needs to last, and how much money that you want left behind. Then you let the math calculate the return that your plan requires. That number is not a forecast. It is not a safe withdrawal rate. It is simply a measurement of how hard your money needs to work. You can then compare that hurdle rate with two market-based reference points. The first is what U.S. Treasury bonds are currently offering, and the second is the long-term return currently implied by a diversified investment portfolio. The important point is that I'm not simply assuming that stocks will earn what they've earned over the last 50 to 100 years. I'm asking what bonds and stocks appear to be offering at today's prices. Let's look at three couples. Each has exactly $2 million saved. John and Jane are 67 years old. They spend $100,000 per year, rising with inflation. Their Social Security provides $50,000 per year beginning immediately. They're comfortable spending down their financial assets by age 95. Their retirement hurdle rate is approximately 3.3%. Linda and Steve are 62 years old. They also have $2 million, but they spend $125,000 per year. They plan to delay Social Security until age 70, when they expect to receive approximately $70,000 annually after future cost of living adjustments. They also want to leave $1 million in financial assets to their children in future dollars. Their hurdle rate is approximately 6%. Drew and Monica are age 64. They spend $150,000 per year and also plan to delay Social Security until the age of 70, at which point they expect to receive approximately $80,000 annually. They are not concerned about leaving an inheritance, but they want extra flexibility later in life. That's important to them, including the ability to pay for a private room or higher level of assisted living care should they need to. Their hurdle rate is approximately 8.3%. All three couples have $2 million, but John and Jane need 3.3%, Linda and Steve need 6%, and Drew and Monica need 8.3%. The difference is not how much money they have, it is what they're asking that money to accomplish. John and Jane's hurdle rate is below what Treasury bonds are currently offering. In theory, they could construct a ladder of government bonds designed to fund their projected retirement spending without owning a single share of stock. And that doesn't necessarily mean that they should avoid stocks. It means they do not need the stock market to make their retirement work. Their retirement can largely be purchased through contractual government cash flows. Linda and Steve are different. Their 6% hurdle is above what Treasury bonds can provide. Their plan requires growth investments and meaningful participation in the stock market. There's nothing inherently wrong with that. In fact, their situation resembles many financially successful households retiring with around $2 million. Their retirement is reasonable, but it is market dependent. They need to understand how much investment risk they must take, what happens if the market declines shortly after they retire, and how flexible they could be if returns disappoint. Drew and Monica have a more serious problem. Their retirement requires approximately 8.3% per year. That's above the long-term return that a diversified portfolio appears to be currently offering in the markets. They cannot solve that simply by moving more money from bonds into stocks. Their plan requires unusually favorable investment results. At that point, the issue is no longer primarily the portfolio, it's the plan itself. Same $2 million, one retirement can be largely purchased, one requires a reasonable amount of market risk, and one requires more than today's markets appear to be offering. The account balance told you none of that. The retirement hurdle rate did. The hurdle rate doesn't replace the Monte Carlo simulation or other retirement planning projections. It answers the question that comes first. Monte Carlo asks, given this portfolio, what are the odds that the plan succeeds? The hurdle rate asks, what return is the plan demanding in the first place, and is that demand reasonable? There's also an important limitation. Markets do not deliver the same return every year. A portfolio can earn a reasonable average return over 30 years and still struggle if the worst market declines occur early in retirement. So the hurdle rate is not the return that you should target. It is the minimum return required by the cash flow math. You still need a reasonable amount of cushion above it. So how can you use your hurdle rate? As I record this, Treasury yields are around 4.5% on average. Below that level, a retirement may be largely fundable through government-backed cash flows. If your hurdle rate is between Treasury yields and the long-term return implied by a diversified stock portfolio, the retirement becomes increasingly dependent on market performance. And once that hurdle rate rises above what a diversified stock portfolio is currently priced to earn, I would say it plainly, the market is not currently offering the return that the plan requires. That does not mean that someone has no options, but the solution probably involves working longer, reducing spending, changing Social Security, or reconsidering another goal. It's not something that can simply be invested away. The hurdle rate will not give you certainty. Nothing will. But it tells you how hard that you're asking your money to work, and whether the return that you need appears to be available. That's the right place to begin. If you'd like to know your own retirement hurdle rate and whether today's markets appear capable of delivering it, that is exactly the analysis that I walk through during an initial conversation. No pressure, no pitch. The link is below. I hope you found this helpful. I'll see you in the next one.